Let me tell you why Japan's latest move might be the best thing to happen to your crypto portfolio this year. You see, the biggest fear on every trader's mind just evaporated. The Bank of Japan finally pulled the trigger on a major rate hike, their first real tightening move in nearly 20 years. And guess what? The global markets didn't just survive it. They basically shrugged it off. Now, I've been watching the yen and the carry trades like a hawk, and the fact that we saw no panic tells me something critical. The financial world saw this coming. It was a planned step, not a surprise attack. But this stability is just the beginning of the story. The real question I need to answer for you is what happens now that this overhang is gone? Let's talk about the elephant that's just left the room. For months, a single question has been hanging over every macro trader's desk, creating a constant low-grade anxiety in the market. What happens when Japan finally moves? That question has now been answered. The Bank of Japan has executed its first significant interest rate hike in nearly a generation, ending the world's last bastion of ultra-loose, negative-rate monetary policy. This wasn't a minor adjustment. It was a structural shift, a fundamental change in direction for the world's third-largest economy. The 10-year Japanese government bond yield, a benchmark for global capital, made a decisive move not seen in almost 20 years. And yet, as I watched the tickers and scanned the volatility gauges in the immediate aftermath, I witnessed something profoundly telling. Not a crash, not a panic, but a collective global sigh of relief. The fear domino effect, it didn't materialize. The yen adjusted, sure, but in a measured way. Global risk assets, including the crypto market, didn't buckle. There was no violent unwinding of the massive yen carry trade, that practice where investors borrow cheap yen to invest in higher-yielding assets abroad. The catastrophic hawkish surprise scenario, the one that kept many fund managers up at night, simply didn't happen. This calm wasn't an accident. It was the result of a masterclass in central bank communication and market preparation. The Bao J didn't ambush the markets. They guided them to this point with painstaking transparency, ensuring the decision, when it came, was fully priced in. The vote was unanimous, and the messaging was cautious, emphasizing that financial conditions would remain accommodative. This tells me the market isn't reacting to the event itself, but to the removal of the paralyzing uncertainty that surrounded it. A known, quantifiable reality is always less frightening to capital than a scary unknown. But to stop the analysis here would be a critical mistake. Viewing this as a mere one-and-done event is to fundamentally misunderstand the seismic shift now underway. What we witnessed was not the conclusion of a story, but the turning of a crucial page in a much longer, more complex narrative. The Bank of Japan isn't simply raising rates. It is attempting the delicate high-wire act of extricating its entire economy from a deflationary mindset that has persisted for over 2 decades. Think about that for a moment. We are talking about rewiring the economic psychology of a nation, moving from an environment where prices were expected to fall, which discourages spending and investment, to one where mild, stable inflation is the norm. This is a generational project, not a quarterly adjustment. The official forward guidance and analyst projections make this timeline explicit. The consensus view points toward a terminal policy rate of around 1.5%, but not until mid-2027. The next incremental hike isn't even expected until July of 2026. This is a glide path measured in years, not months. It's a slow, deliberate burn, not a flash in the pan. Yes, the headline unemployment rate might look manageable, but that's a surface-level view. To understand the real pressure building beneath the surface, you must look at the U6 rate. This isn't just the unemployed. This includes people who are marginally attached to the workforce and, most importantly, those who are working part-time but desperately want full-time work. This gauge is a better thermometer for economic distress, and its recent creep upward is a red flag I cannot ignore. It signals that underemployment, the quiet crisis of people stuck in jobs that don't pay enough or provide enough hours, is becoming a more widespread problem. This isn't abstract data. It represents millions of households feeling their financial security slowly erode, their ability to save or invest in it. Simultaneously, if you want to feel the true temperature of the American consumer, don't watch the stock ticker. Watch the Michigan Consumer Sentiment Index. This measure of how ordinary people feel about their current finances and the future outlook has been languishing at levels historically associated with recessions. The narrative of a strong economy completely collapses when held against this persistent despair. People are in the stores, they're on websites, and they are feeling the relentless pinch of prices, not just for gas and groceries, but for services, for insurance, for every facet of daily life. Their long-run inflation expectations remain stubbornly elevated, meaning they don't believe the problem is going away. They are financially stressed, anxious, and pulling back on discretionary spending in ways that will eventually reverberate through corporate earnings. Yet, here is the bizarre, almost surreal counterpoint. While this sentiment of struggle dominates Main Street, Wall Street is in the midst of a raucous, record-breaking party. The S&P 500 and the tech-heavy NASDAQ are not just up, they are shattering all-time highs with a consistency that feels detached from the ground-level economic experience. The divergence is staggering. How is it possible that the market representing the largest publicly traded companies can celebrate with such vigor, while the very consumers who support those companies are feeling so financially besieged? This isn't a minor discrepancy, it's a fundamental disconnect that defines our current moment. The answer to this puzzle reveals the new, uncompromising rule of the modern market. We are not witnessing a broadly shared prosperity. What I believe we are seeing is the dramatic acceleration of a K-shaped recovery on a societal scale, morphing into a permanent feature of the financial system. There is a narrow cohort of asset owners, those with significant exposure to financial portfolios, real estate, and equity-based compensation. And then there is everyone else. The massive liquidity injections and fiscal stimuli of recent years didn't rain down evenly. They flooded into financial assets first and foremost, supercharging the net worth of those already holding them. This concentrated capital is now a self-reinforcing force, continually bidding up the prices of the assets it already owns, creating a feedback loop of paper wealth for the top tier. This dynamic is why the old communal playbooks for markets, especially for crypto, feel utterly broken. For years, many in our space have been patiently, faithfully waiting for the classic retail-driven explosion, the moment when the excitement spills over from Bitcoin into the altcoin universe, creating those parabolic, life-changing runs. We keep looking at the calendar, referencing the 4-year cycle, and waiting for history to repeat. I think we need a moment of painful honesty. It hasn't happened in the way we expected, and the primary reason is no longer retail sentiment. The reason now resides in the sleek, glass-walled boardrooms of institutional asset managers. The fundamental personality of the crypto market has undergone a quiet but total transformation. The loud, chaotic, meme-driven retail crowd that defined the 2017 and 2021 cycles is no longer the dominant price-setting force. They are still here, but they are now swimming in an ocean managed by institutional whales. The big players, hedge funds, asset managers, corporate treasuries are now in charge, and they operate on a completely different set of rules with a different psychology and different objectives. They are not driven by community hype, Twitter threads, or the fear of missing out on the next Shiba Inu. They are patient to the point of being glacial. They are ruthlessly tactical, not devoutly evangelical. Their approach to crypto is not buy and hold for the revolution. It is a calculated game of risk, on, risk off of relative value trades and liquidity harvesting. They view Bitcoin not as digital gold, but as a high beta tech-adjacent liquidity instrument. They see altcoins not as world-changing protocols, but as extreme volatility vehicles to be traded in and out of with precision. They are fully willing to sell into retail-driven rallies and during retail-induced panics because their time, horizon, and their emotional detachment allow it. They are not emotionally invested in the crypto story, they are financially allocated to its volatility. Don't just take my word for it. The evidence is etched in cold, hard performance data. Look at the year-to-date flow leaderboard for exchange-traded funds. Among the top performers, you'll see funds tracking gold, international markets, and tech posting returns of 30%, 40%, even over 60%. And then you'll see iShares Bitcoin Trust, one of the largest spot Bitcoin ETF, sitting there as the solitary outlier with a negative return for the period. Let that sink in. In a year where risk assets have broadly soared, the premier accessible institutional gateway to Bitcoin is in the red. This is a glaring, undeniable signal. It tells us that, for now, institutional capital views crypto as a tactical trading vehicle, not a strategic, must-hold allocation. The money is present in the ecosystem, but its posture is one of exploitation, not conviction. It's waiting for the right technical setup, the right macro catalyst, the right moment to pile in for a trade, not to build a long-term position for a decentralized future. This changes everything about how we must think about price action, momentum, and the very definition of a bull market. The rules have been rewritten by a new class of players who play a very old Wall Street game, and our first step toward success is acknowledging that the game itself has changed. So where does this new reality leave Bitcoin, altcoins, and our strategies? It forces a difficult but necessary reckoning. The perpetual bullish mantras, the unwavering chants of number go up, are facing their most severe stress test in years. Yes, seeing key price levels defended is psychologically important. It shows a base level of demand. But in this new regime, a persistent lack of sustained upward momentum speaks louder than any successful defensive support. It tells a story of a market trapped in a holding pattern, not for lack of interest, but because the dominant capital allocators have not yet issued the all-in signal. The entire narrative framework around crypto has subtly but decisively shifted under our feet. For years, the dominant story was one of inevitable adoption, of a flippening of crypto as an uncorrelated hedge against a failing traditional system. That story is now on pause. In its place, a more immediate, less ideological narrative has taken hold among the institutions now holding the purse strings. Crypto as a high volatility risk asset, pure and simple. Its price action is increasingly viewed through the lens of global liquidity, relative performance, and rotational flows within a broader risk appetite bucket. While narratives around AI, cloud computing, and semiconductor supremacy are driving trillion-dollar valuations and offering seemingly clearer growth trajectories with lower perceived regulatory friction, crypto is stuck in a choppy, frustrating, sideways grind. This isn't a coincidence. This price action is the direct reflection of institutional hesitation. It is the anchor currently preventing a breakout. The capital is there. It's clear from the flows into tech stocks, but its preference is for a different kind of risk. This institutional anchor exerts an even more powerful gravitational pull on the altcoin universe. For projects outside the sanctified top 5 or 10 by market cap, the challenge in this environment is existential. The previous cycle model was simple. Bitcoin leads, excitement builds, liquidity trickles down into Ethereum, and then floods into smaller caps in a frenzied search for the next 100x gem. That model presupposed a tidal wave of new, enthusiastic, and often inexperienced retail money, the kind that fueled the ICO mania of 2017 and the DeFi NFT summer of 2021. That wave has not materialized. Without it, the altcoin ecosystem is facing a severe liquidity drought. Many projects, regardless of their technological merit or community passion, are struggling to find the oxygen, the consistent buy-side volume needed to break out of their depressing downtrend. The institutions that have entered the space have shown a distinct preference for liquidity and simplicity. They buy Bitcoin ETFs they might allocate to Ethereum, and they largely ignore the rest. This creates a brutal dichotomy, a market that is more institutionally mature than ever at its top, yet potentially more fragile and illiquid than ever in its vast long tail. This harsh diagnosis leads me to the most crucial actionable point I can offer you today. Your personal strategy must undergo a fundamental adaptation. The game has irrevocably changed, and clinging to the playbook from 2021 is a recipe for frustration and capital erosion. The core ethos can no longer be passive hodling based purely on historical cycle charts and hope. That approach cedes all initiative to the market's whims. The new imperative is active comprehension and strategic positioning. Success now hinges on understanding the flow of institutional liquidity, anticipating its movements, not just reacting to them. This requires a different skill set. Well, it means developing a sense for macro triggers, reading Treasury yield movements, and interpreting the language of Federal Reserve statements with as much attentiveness as you read crypto Twitter. It means that traditional technical analysis, support, resistance, volume profiles becomes more critical than ever, as these are the maps institutions use to plan their trade. This evolution in mindset might logically lead you to consider tools and approaches that the pure HODL culture previously scorned. I'm talking about understanding the mechanics and strategic use of derivatives, futures, and options. Not for reckless gambling, but for precise hedging and defined risk speculation. It might mean engaging with the market in both directions, understanding that in a choppy, range-bound market, opportunities can exist on the short side as well as the long. Let me be unequivocally clear. This is not an endorsement of reckless leverage. In fact, it demands stricter, more professional risk management than ever before. The institutional game is one of risk-adjusted returns and capital preservation. Your approach must mirror that discipline. The cynical, patient, and calculated mindset that is currently printing gains in the S&P 500, a market willing to sell on good news and buy on bad, is the exact same mindset you must cultivate to navigate crypto's next chapter. The data is whispering that we are at an institutional inflection point. Your edge will no longer come from being an early believer in a project. It will come from being a smarter, more disciplined tactician than the person on the other side of the trade. Nothing illustrates this new reality more perfectly than one singular chart. The 30-day performance comparison of the S&P 500 against Bitcoin. Place them side by side. On one side, you see a steady, almost effortless climb, a line graph marching with confidence toward new peaks. On the other, you see a jagged horizontal squiggle, a line graph representing frantic energy with no net directional progress. This visual is the entire thesis. It screams that liquidity is abundant and active in the financial system, but it is pointedly not flooding into digital assets. It is content to chase momentum in mega-cap tech, in AI, in the Magnificent Seven. This chart is the most important one on my screen because the signal for crypto's next major leg higher will not be a viral tweet from an influential founder. It will be a sustained, decisive break in this correlation. It will happen when that vast pool of sidelined institutional-grade capital finally gets bored with the returns in traditional tech, when its quantitative models start flashing that crypto offers a more attractive risk-reward profile, and when it rotates in size. That rotation will be swift and will likely catch the nostalgic retail crowd flat-footed. Of course, the path forward is not clear. The macro sky remains turbulent with gathering storm. Looming trade wars, potential legal battles over tariffs that could rewrite global supply chains overnight, and intense speculation about the future leadership and philosophy of the U.S. Federal Reserve. These are not minor footnotes. They are powerful wild cards that will define the volatility and opportunity of 2026. They are not today's immediate price drivers, but they form the complex, unpredictable backdrop against which all institutional allocation decisions will be made. So, the removal of the Japan fear is an undeniable positive. It strips away a major source of potential systemic risk. But we must be precise in our definitions. A bottom isn't formed merely by the absence of bad news. A true durable market bottom is forged when a new, compelling, and fundamental reason for big money to buy emerges and is acted upon. That reason is not yet clear in the public domain. It is currently being debated in the Monday morning meetings of macro hedge funds modeled on quantitative dashboards and discussed in the hushed tones of investment committee rooms. The catalyst is in gestation. Therefore, I will leave you with this final thought to frame your perspective moving forward. The spark that ignites the next major crypto bull run will not originate from a viral meme or a trending hashtag. It will not be announced by a charismatic influencer on a podcast. That era, while not gone, is no longer dominant. The Spark will be far more clinical. It will be a PDF attachment to an internal email, a cold, calculated allocation memo from a chief investment officer to a trading desk. It will be a line item quietly added to a multi-billion-dollar pension fund's quarterly rebalancing report. It will be the silent, collective decision of algorithms programmed to hunt for momentum shifts. The next bull run will start on a spreadsheet, not a meme page. Understanding this is the first and most important step in playing the new game. If this breakdown of the new market rules has given you a clearer map to navigate what's ahead, I need you to do one thing for me. Hit the like button right now. That single click is the strongest signal you can send that this deep dive, no hype analysis, is valuable, and it tells the YouTube algorithm to share this with other serious investors who need to hear it. Then subscribe to Market Trends and turn on notifications. We're just getting started. In the coming weeks, I'll be breaking down exactly how to build a tactical strategy for this institutional era, what macro signs to watch for the coming rotation, and which charts are flashing early signals. I read every single comment, so tell me below, what's the one question you have about adapting your strategy right now? Your input directly shapes what we cover next. Let's navigate this new game together.